A few days ago, just before Fitch downgraded our spender-in-chief, the Treasury Department announced it plans to borrow what the Wall Street Journal termed an eye-popping amount. $1 trillion over the next 3 months alone, and a projected $1.85 trillion over the next 6 months. Both were 40 to 50% higher than Treasury's last estimate just 2 months ago. Note that was before the debt ceiling surrender, so Treasury may have been lightly cooking those books. UK bank Barclays termed the $1.85 trillion a, quote, Treasury tsunami. Meanwhile, new figures show federal spending jumped 18% in June on the year ago to $646 billion on the month. That's an annualized $8 trillion, which is almost double what the feds collect. Meanwhile, tax receipts also slumped 9% to just $418 billion. That comes to a $228 billion hole on the month alone, which is roughly $7 billion of fresh debt per day. Put them together, and the budget deficit, which is already up 170% on last year, is set to soar. The problem is who would buy all that eye-popping debt. I've mentioned recently how Japan's monetary policy and China's slowing economy could turn two of the main buyers of U.S. debt into sellers. Together, today, they hold roughly $2 trillion. Meanwhile, the Fed is rolling off its $5 trillion stack of treasuries, rolling off meaning letting them expire and not buying new ones, to the tune of $30 billion per month, expected to double to $60 billion per month in September. So if the three main buyers of federal debt are now sellers, who's going to buy that $1.85 trillion? Keep in mind, China is also busy bribing countries out of the US dollar, both as part of the BRICS project and with its development banks that lure countries off the greenback. The last man standing is private buyers, which drains money that, in theory, was supposed to finance the real economy, so businesses, households, homeowners. So what happens next? The Journal quotes one expert worried about what we saw in the UK last year when fears over government debt sent bond yields skyrocketing 140% in 2 months. That crashed UK bond prices, which put banks and even major pension funds at risk of bankruptcy. Meanwhile, the British pound plunged, losing 24% of its value against the dollar in just a couple months and almost hitting dollar parity. That's what you would expect from a third world country, not the United Kingdom. The British government, of course, panicked, ditching a planned tax cut to revive the economy, essentially waving the white flag that perhaps the UK can never again cut taxes now that it has become a slave to its national debt. Keep in mind, the US is in much worse shape than the UK. The UK's national debt just passed 100% of GDP, while the US is bumbling along at 137% and apparently rising fast. So at best, our coming federal debt tsunami would drive up debt interest payments, which are already $1 trillion a year, and on track to $1.6 trillion even before the latest surprises. At worst, we get a UK-style panic, with soaring yields and crashing bonds that put yet more banks and even pension funds on the chopping block. The $1 trillion bailouts we've already seen could expand exponentially, pulling us towards that great everything bailout. Okay, we'll be watching. See you next time.